I would still say that the high execution, high vacancy, big renovation deal is less risky than the bridge debt. Why? Because you can control those things. You can't control what the Fed does. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Discusses. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Discusses, and I'm excited to be back here. So, look, I did an episode a couple of weeks ago, and it was about a question my daughter asked. It was a faith-based question. She asked me how God works in my business, and I was hesitant to actually record that episode because it was going to be talking about my faith the whole time. And I did. I recorded it, and I've got an outpouring from people that thanked me for recording that episode, that told me it was an awesome episode, all that kind of stuff. So I really appreciate those who did reach out to me and tell me that, encourage me to maybe do more of that. So yeah, I really appreciate that. Appreciate people reaching out. And anytime, feel free to reach out to me. Tell me what you want me to talk about on this podcast. It doesn't mean I'm going to actually cover it, but I love hearing suggestions. And hey, would love to have you cover this topic, or what do you think about this? Could you cover this in your podcast? Here's a question I have for you. Would love to hear those questions from you. You can reach out to me on LinkedIn. You can message me there. Or Facebook, you can message me there. Or if you have my email address, you could send me an email as well. I want to talk quick today about what to look for in a passive investment. And so I think it's really important to kind of clear some of the confusion around what to actually look for in a passive investment. It's a lot different than investing in the stock market, stocks and bonds and mutual funds and so on. Like, you kind of just listen to your financial advisor on those. Maybe you have a few things that you look for, but for the most part, you're investing in whatever your financial advisor says, or maybe if you're doing it yourself, you've got your own formula. But when you're investing in, an LP position, I think you've got a lot more to think about in how you should be investing and what you should be investing in. It's really easy to get caught in bad deals, and not really understand that. And I hear everybody talk about, you got to make sure you know, like, and trust the sponsor. While I agree that's true, know, liking, and trusting the sponsor is important, it is not the end all be all to making sure you have a good investment. So some people just blindly will follow a sponsor without really looking at how is that sponsor going to be able to be successful and what are the risks associated with that investment. And so, there's plenty of deals that have gone sideways over the last really 36 months and are continuing to still go sideways. I mean, I hear it all the time. I talk to people all the time that are in these deals and very reputable sponsors. So what went wrong? If the sponsor was good, why did the deal go bad? And it's because of the business plan that was set up in the first place. It's because of the risk behind this investment. And most of these deals that have gone sideways are because of the loan terms. And the loan on these deals were bridge loans. They weren't fixed rate. They were floating, and they may be fixed for a certain amount of time, right? They have I shouldn't say they're not even fixed. They have a rate cap. They have a rate cap that's an insurance policy that basically says, hey, if the interest rate goes above X amount, whatever they buy the rate cap at, that this rate cap will actually cover the spread. So the max you'll ever pay is 5%, 6%, 7%, whatever it might be, whatever you purchase. But that's an expensive tool that you have to purchase, and that tool. What a lot of people did is they got these bridge loans that were floating rate. They're locked for, they're locked. They're a 3-year term, and they've got 2, maybe 1-year extensions, maybe 1, maybe 2 1-year extensions. And so the loan itself is a 3-year term, and then a possibility to extend. Now, it's not a guarantee; it's a possibility. The lender doesn't have to extend. The lender can decide if they want to or not. And in some cases, they didn't. And then what happened is you got potentially you got a rate cap, and so you had to buy this rate cap. Now, depending on when you purchase this building, the rate cap didn't cost that much. It maybe costed 50 grand, maybe up to 100 grand for a rate cap. And that was going to lock you in for 2 years, maybe three. But most people did like 1 to 2 year rate cap because they thought they were going to basically flip the property, buy it, get rid of it quickly and make their money. Well, when they bought in 2019, 2020, 2021, and even 2022, they bought it with the intention to renovate and to sell. And then the market started to shift. And so it became a little harder to actually get your rents and get your occupancy, and expenses were going up pretty drastically. That was probably the biggest thing, is expenses that hit first. Expenses were going up. So your NOI wasn't growing what you thought it was. But what really happened is interest rates skyrocketed, and more than anybody ever predicted. And if you tell me you predicted this, or somebody tells you they predicted that interest rates would do what they did, they're crazy. They're just lying to you. That's it. That's all. There's nothing more to it than they are lying to you, because nobody predicted it. And even the most aggressive predictions where they were going to go up, rates will go up by about 300 basis points, over 12 to 24 months. Not that they would go up, 500 basis points. And it was just like hockey stick curve, right? It just went straight up. And so what that did is that caused a lot of stress in these floating rate markets, and people had their rate caps, and the rate caps would expire, and now they got to buy a new rate cap. And that rate cap that used to be $50,000 was now $250,000. And so they had to come up with money for that, or even more potentially, to come up with money for that, and if they could even afford it. And that was going to put a lot of financial strain on it. And then of course, the rate, they're probably buying a rate cap that wasn't quite good enough. So it really made their rates high, because what was going on was all these deals were SOFR plus, call it 350 to 450. Okay. So that meant your interest rate was really like 3.5 to 4.5% interest, like super good interest rate. Well, now with SOFR at 5 or higher, like, you're buying a rate cap, but your interest rate's already starting at 5. So if you're buying a rate cap with a zero strike, your interest rate is at 5. It's higher than it was before already. And that's a really expensive rate cap. So most people are buying a rate cap at, like a 2 or 3 strike, 4 strike. And so now it's SOFR plus, let's say about it at a 3 strike, SOFR plus 3. So when SOFR's at 5, now you're at 8% interest rate. And that's a huge, huge difference. And so that's what was the big risk for these investments. All right. So I got sidetracked. I wasn't going to talk quite about that, but my point here is that you could have the best sponsor in the world. In fact, I know some amazing sponsors that got tied up into some of these loans. And we did not do a lot of these loans, but we did do a couple of them. And the few that we did, we've had problems with. The few that we did aren't great investments. And so we don't do those bridge loans anymore. We only do fixed rate debt. But those few that we did are not good deals. And so it's a lesson that I learned, and I think most sponsors learned this lesson, is that fixed rate debt makes way more sense in 99% of all cases. If you're buying deals with floating rate debt, you just didn't learn your lesson. Like, I don't know many companies that are buying deals right now still aggressively with floating rate debt. Now, a few of them are buying a deal here and there with floating rate debt. I still don't love it, but I can get on board with it depending on the business plan and all of that kind of stuff. But that's what you got to look at. And so, are you an investor that wants risk or reward, or both, right? Or do you want safety and security? And if you're going, hey, I like high risk, I'm willing to take it, then you should invest into deals that have bridge debt, because that has the greatest potential for profitability. Now, it has the greatest potential for a complete loss, way higher, way higher than anything else. So you just got to look at it as your investor, like, hey, I like this sponsor. They're a great sponsor, and I love a lot of risk. And so I'm going to invest in bridge debt deals with this great sponsor. Or, hey, I like to be a little more conservative. I like this sponsor. I'm going to invest in these fixed rate deals. So to me, that's number one is what type of risks are involved in that deal. That's what you should be looking at. Again, the sponsor is important, but I think more important than the sponsor is the deal and the business plan behind the deal and then the market behind the deal. So here's what I'm going to look at. What type of business plan do they have? All right. Is this a core asset? Meaning this asset doesn't have any work to do or very, very little. Maybe there's a little paint touch-ups here and there. Like there's no work, right? If this has no work, fixed rate debt, great location, all of that, think, brand new A-class building, that's already full, by the way, that's 100% or 98% occupied. And we don't rely on rents growing, all that kind of stuff. That's a safe, secure investment. Like the chances of you losing money on that are probably slim to none, right? But you should expect your returns not to be as great. I mean, you're probably like 10% type of returns on that. That's fine. If that's what you're looking for, that's great. And that's pretty safe. Like I would say if returns are projected at 10%, you're getting somewhere between 8 and 12%. Which is like pretty standard. All right. So then the next deal is going to be more just a little bit lighter renovation. So it's maybe a light value add. Again, still fixed rate debt, light value add, got to raise rents by $100, something like that. Already 95% occupied, everything's good. And it doesn't rely on massive rent bumps. And so if the rent bumps don't take place, maybe they can only bump rents by $50 or $25 or something like that. Yeah, your investment now the 12 to 14% IRR that was projected turns into maybe a 10% IRR. Okay, that's fine, but still a pretty safe investment. Chances of you losing everything pretty slim. And then you got the heavy value add. So then you got the moderate to heavy value add. It's just moderate to heavy value add, again, a little bit more risks. And then you got the really heavy value add where you've got, lots of vacancy rate. Maybe we bought one 65% vacancy, all that kind of stuff. So it was 65% vacancy. It was a great market. Huge renovation, $40,000 a door, $4 million for 100 units, big renovation. Not stable, not at all. So that's a pretty high risk element to it is the renovation. But one thing we did to mitigate that renovation is we added fixed rate debt. So long-term fixed rate debt, local bank, very secure, very solid debt. That's not going to cause risk. So we had the risk of the execution. Now we've executed extremely well, but we have the risk of the execution, but we didn't have the risk of the debt. So that's definitely on the risk spectrum, much higher risk than some of those first type of deals I talked about. But I personally think that it's much lower risk still than even that moderate value add. You buy the building, it's 95% occupied. You got to do the renovations to it. You're going to raise rents by $100 to $300 a month type of thing. But you put floating rate debt on it. I would still say that the high execution, high vacancy, big renovation deal is less risky than the bridge debt. Why? Because you can control those things. You can't control what the Fed does. You can't control that. And so I just think that bridge is extremely risky to do. So you got to look at where you are on the risk factor and what you want to do. If you want to make lower returns and just preserve your capital, go with the core, just simple core. Get that 8 to 10% return on your money and be happy with it, right? If you want a little bit better, but still want to preserve, again, super light value add. And then if you're like, hey, I want to take a little bit of risk, but not a crazy amount of risk, just the value add, like the regular value add, where we're talking 150 at the minimum, probably 350 at the maximum rent bumps, where we're doing $20,000 a unit or less renovations. Bought the building, it's 95% occupied. We're going to renovate it, keep it about 90% occupied during the renovations, and we're going to have a nice value add. You expect your 14 to 16, maybe 18 IRR on that type of deal. That's that's my favorite type of deal. I think that's a good deal where you're not too risky, but you're still seeing some good upside as long as you're using fixed rate debt. Take that deal, throw floating rate debt on. I think that's high risk profile deal and could have some high upside returns, but high risk. I would say in order for me to do that deal, I got to have returns that I think can easily hit minimum of 20%. And quite frankly, I don't think I would do that deal, but minimum at least 20% IRR. So we're talking risk of the deal is to me is number one. Execution of the deal. Can this company actually execute on the deal? Have they executed on this type of deal before? I think is really important. So now we're going back to the sponsor a little bit, but on their actual execution of the deal, can they and have they executed on these types of deals before? Do they have a well thought out business plan? And also, what are their backup plans when the business plan goes awry? Like, look, what happens if they're not getting the rent bumps? What are you going to do? Are you going to just keep on renovating those units? What are you going to do? How are you going to change? How are you going to change to make sure you're not just getting crushed, right? You're not just going through just to go through because you had this business plan. What adjustments are you willing to make? What kind of, what have you put in your underwriting that shows me that you've put some thought into scenarios that could happen? I think is really important too, is in like this business plan is here, but we all know that it never works out 100%, like never works out exactly as you plan. So what can you do to mitigate some of those risks? What are the risks? Spell them out. And then, what are some scenarios that could happen? I think those are really important to really think about and to be able to be okay with and be able to wrap your head around. Location, I think, is really huge. And I think here's the thing that, like, to me, these are big things that are downplayed. Like, people don't talk about them, but I think location's big. I think you have to have a good location. And if you're investing in C-class areas, not that that's a bad thing, but why are you investing there? Why do you feel strong in that thesis? And then what are you doing to mitigate the risk of a C-class location? Because C-class is never performing. I shouldn't say never. That C-class traditionally doesn't perform as well as A or B class. And we're seeing it right now. I mean, C-class cap rates have increased the most, and you're seeing the highest vacancy rates. You're seeing the most delinquency rates, all that kind of stuff at C-class. So people can sit here and pretend and tell you that C-class is great because, B class renters move down to C-class, and that's not the case. Like, that doesn't happen. Rarely ever do people go from, living a certain lifestyle to going to a lower lifestyle, especially in a higher crime neighborhood, for sure. It just doesn't happen. So, why are you okay with that? And there you go as an investor too. That's another risk factor. Is this A class, B class, or C class neighborhood, A class, B class, or C class property within that neighborhood? And if you've got an A and an A class property and an A class neighborhood, that's going to be the least amount of risk. If you've got a C class building or even D class building in a C or D class neighborhood, well, that's going to be the highest amount of risk, right? So you want to make sure, again, in that risk, that you're looking at the location. But what's happening in that location? Why is it positive? Why is it growing? I think those are really, really important factors to think about. When we look at underwriting, I want to make sure there's a couple main things you want to make sure you're looking at. First of all, what's the current cap rate? Not what cap rate are they buying it at, but what's the actual current cap rate of the market that property is selling at? So what are the comparable sales in that market? You want to go by both cap rate and price per door. I think that's really important to not discount either of those. So I want to make sure, like, hey, yeah, this guy is telling me or gal's telling me, like, look, current cap rate's at 5.3%, but that's just what they're buying it at. Like, who cares if you're buying it at 5.3% if the market is at 6.2%? Like, that's what the market's at. That's the actual comp. And so you got to base it on that. That's the comp. base it on 6.2%. So if their exit 5 years down the road is 5.6%, they're like, hey, we're being conservative. See, we're buying it at 5.3, we're selling it at 5.6. No, wait a second. The market's 6.2. You're selling it for 5.6. You're showing a big drop in cap rate. Now, could I get on board with that? Maybe, depending on the market and depending on what's going on in that market, but probably not. And so just make sure that you understand. And then the other thing too is like, look, they're buying it at 160 a door, and they're going to put 30 into it, and they're going to sell it for, 235,000 a door. But you go, well, wait a second. The highest priced comp right now is selling for 185 a door. How are you going to get that? So you got to make sure you're looking at that price per door, and why can you actually get that price, and is it truly achievable? You want to make sure that's achievable. So I think that's really important to be looking at underwriting. And the other thing with underwriting too, and there's some, I don't want to call them tricks, because I don't think people are truly trying to trick you. I think that sometimes people just have false beliefs, or just overly optimistic hope in what's going to happen in the market. And by the way, they could be right. So their optimism may be well founded. So you just definitely verify for yourself, and again, decide, is it worth the risk? The 5.6 cap and a 6.2 cap market is definitely higher risk than if somebody else is underwriting in a 6.2 cap market. They're underwriting an exit of 6.8, right? 6.7. That's 50 basis points higher, right? So if they're saying, hey, we're going to exit at 6.7, that's definitely much more conservative and less risk than the opposite way, certainly. So you just got to be able to be okay again with the risk and know that risk that's involved when you're going into this deal. The other big thing though is rent growth. And I think it's really important. We saw, 2020, 2021, 2022, a lot of projections showing like 5% rent growth and 4 or 5, even 6% rent growth. And I think that's really just not achievable. And we're starting to see it again. And the reason why we're seeing it again is because there's no new developments coming on the market, or very few, right? And now people are thinking that rents are going to skyrocket. And that, by the way, they might be right. And it might be okay to actually invest in one of these assets that show 5% rent growth, 4% rent growth. But again, it's a risk factor. Are you willing to take that risk factor? Do you feel like that risk is worth it? Because what happens if it's only a 2% rent growth? Because right now it's maybe not even any rent growth or negative rent growth. And so what's going to make it flip? And then is it going to actually sustain at their level? And if it doesn't, what does that do to your investment? So I think you got to look at rent growth conservatively and understand what's happening with the rent growth, and understand how they're underwriting rent growth too, by the way. So I see people that show projections of 2 or 3% rent growth, yet the actual math, when you look at the pro forma, is much, much more aggressive than that. And so you do your own math and make sure that they're actually growing on their underwriting the way they're telling you the rent is going to grow. I've seen that plenty of times play out. And so why are they telling me that the rent's going to grow 3% or 2%, but yet on their pro forma in the first couple of years, it's growing 6 or 8%. Like, what's going on here? Why are you showing that? And maybe they have a good justification. I don't know, but I find it strange when I do see that on some people's pro formas. I don't know. I just can't get on board with big, huge rent growth. Especially in some of these markets that are seeing rent declines. Like, it's crazy to me to project 3% rent growth in a market that's currently seeing, negative 2% rent growth. And it's like, what are you doing? How are you even justifying that? Especially when you're showing 3% in year one, like maybe 3% by year 2 or 3, I could get on board with potentially, depending on what's going on in that market. But showing it in year 1 and year 2, like, that's super aggressive. So what happens to your investment if those don't take place? By the way, it's a snowball effect. So the snowball starts out slow and builds pretty quickly. When you show 3% rent growth in year 1 and you achieve negative 2% rent growth, that's a huge difference especially 5 years down the road, right? That's a huge difference. And now this investment that looked like you're going to get a 16 IRR gets you an 8 IRR, right? Because they were overly aggressive in their rent growth projections. All right, there's a lot more that we could talk about and things to look for. I've done plenty of podcast episodes on this, um, but I think those are super valuable to be looking at in with a sponsor. And again, the sponsor does make a big difference, and I think you got to make sure you're investing in the right sponsor. But don't just take a sponsor that has a reputation, especially an online reputation. Don't just take that sponsor and assume that they're good at what they do. Really get to know actually the business plan and get to understand the location and get to know the projections and actually understand, does this deal make sense for me from where I am in my life and for the risks that I want to actually take, and the financing, right? Understand, is this the risk that I'm willing to take? Do I like this deal enough and do I like this sponsor enough to do this investment? Now, I don't want you to freeze and not do anything. I think it's really important to take action, but I do think it's really important to take the right action as well. So do your homework, do your due diligence, and decide for you what's right for you. Just because I don't love bridge debt, just because I think it's super high risk, doesn't mean it doesn't fit your risk tolerance. You got to decide if it's right for you. All right. That's it. That's all I got for today. You have a fantastic rest of the day. Make every day a Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.